Hello everyone. Welcome back to another episode of our series. Today, we're diving headfirst into what's been a rather intriguing and turbulent week in the global financial landscape. As always, I do my best to bring to light the key issues that many governments and central banks hope the everyday person won't dig too deep into. But remember, we're all about shedding light on reality. No sugarcoating, no political rhetoric. The present conundrum? Something that, if it hasn't yet hit your friendly neighborhood economic news report, is soon bound to dominate the headlines. While the rest of the world is aggressively slashing its interest rates to prop up faltering economies, Japan, of all places, is doing the unthinkable by contemplating rate hikes. And the irony? The Bank of Japan, BOJ, notorious for almost 2 decades of ultra-loose monetary policy, is suddenly standing out for its more hawkish stance. This while everyone else, from Europe to North America, holds on to dear life by easing rates in a desperate bid to fend off what appear to be flashing red signs of global economic slowdown. So what's going on? What are the economic ghosts haunting these central bank decisions? And how will this impact both regular citizens and professionals managing assets in the global economy? Let's dissect this from a broader perspective. Before we get into Japan's peculiar stance, let's first discuss the global context. Across the developed world, recession fears, weak growth data, and political anxieties are forcing central banks into making deeper cuts in interest rates. Consider the Bank of England. BOE Governor Andrew Bailey is stepping on the gas, hinting that the BOE might adopt a bit more activist stance to lower rates. Why? The bank is staring at a weak British economy, partly plagued by persistently sticky inflation, but also facing stagnation risks post-Brexit. Economic reports in the UK haven't exactly been stellar, leaving room for plenty of concern. In Europe, traders are placing bets on an even more aggressive rate-cutting path by the European Central Bank, ECB. Weak economic data across EU member state economies underlines the growing fragility in the region. The euro is sinking, but so are hopes, some may say, as it heads toward its longest daily losing streak since April. Even in markets like Canada and Sweden, traditionally viewed as stable economies, things are spiraling. Economic slowdowns here have resulted in increased expectations for further easing. The United States, meanwhile, delivered one of the sharpest post-pandemic rate hiking cycles in history, but now even the Federal Reserve seems to be reconsidering its recent moves. A weaker-than-anticipated jobs report in August has triggered new speculations that the Fed might move towards smaller rate cuts or even a rate pause in the coming months. It's a dramatic shift in tone given the hawkish position the Fed held throughout much of 2023. But amidst all of this, guess who refuses to fall in line with this global easing trend? You got that right, Japan. So why isn't Japan following the crowd? Why is the Bank of Japan flirting with the idea of raising rather than lowering rates, especially when the global economic storm looks set to batter all corners of the world? First off, let's all remember, Japan has been stuck in a liquidity trap for years. Scroll back to the early 1990s, and Japan's economic miracle spectacularly imploded. Ever since, they've been grappling with deflation, stagnation, and zero interest rate policies that seem to stretch into infinity. The BOJ is in new territory after keeping rates at near zero for over 2 decades. Their own normal has been nowhere near the normal of other advanced economies. Then came their first rate hike in a decade. BOJ Governor Kazuo Ueda stepped up earlier this year and implemented not one but 2 small hikes, bringing their benchmark rate to a still shockingly low 0.25%, the lowest among developed nations. This was expected to signal a change, the beginning of Japan's normalization process as demand finally began to catch up. Remember, Japan's core inflation has risen above the BOJ's 2% target for over a year now, with the Core Consumer Price Index, CPI, increase clocking in at 2.8% in August 2024. But here's the rub. It's not just a domestic issue anymore. Amidst the BOJ's attempts to normalize, the rest of the world has gone into reverse, raising the risks and creating myriad challenges for Japan's path forward. Now, here's a crucial angle that financial professionals are especially keen to focus on: the yen and how the international financial landscape's manipulation of rates has compounded the BOJ's conundrum. With the euro weakening and global interest rates on the decline, the yen has been wildly fluctuating. Last week, after Sanai Takaichi, an anti-rate hike candidate, lost to Shigeru Ishiba, the yen surged in response to expectations that Ishiba would support further rate hikes. That surge, of course, was followed by a dramatic pullback in Japanese equities, with the Nikkei tumbling as markets grappled with the impending uncertainty of Japan's monetary trajectory. Why do rate hikes, or even the anticipation of them, hold so much sway over Japan's equity markets? Think of it this way. Japan's prolonged period of deflation and near-zero rates has cemented a carry trade habit, where investors borrow cheaply in yen to fund higher-yielding investments abroad. This massive global investment vehicle relies on Japan's continued low interest rates. But imagine that carry trade safety net evaporating. Even the smallest rise in rates by the Japan Central Bank sends shivers down traders' collectively spines, threatening this decades-long reliance on a near-costless source of yen-denominated capital. That's part of the reason why market volatility has increased with each flicker in BOJ policy. The global FX market has shifted accordingly, with the dollar-yen relationship becoming highly sensitive to any BOJ moves. For the global investor community, even marginal changes in Japan's rate policy hold outsized implications for global stock and bond markets. Just look at how the yen surged when the American dollar was weakened from Fed dovishness and Japan's ultra-low rates suddenly faced the potential challenge of BOJ normalization. At face value, all of this monetary drama looks like a chess game between central banks, each trying to steer or defend his or her kingdom from the dangerous winds of global financial catastrophe. But beneath the chessboard is real living, breathing economic livelihoods, business owners, employees, mortgages, pensions, currency valuations, and much more. Policymakers can shift their pieces to block recessions, pump up the economy, or cool it down. But when they move too late or too aggressively, it's you, ordinary people, and professionals wagering their savings and investments who feel the pinch. If Japan inadvertently tips the apple cart by pursuing rate hikes too soon, it could cast a shadow over its long-fought efforts to restore inflation and growth. Businesses, already burdened with challenging operational costs from labor shortages and raw material import expenses, may see profits squeezed even further. Critically, Japan could fall into a familiar trap, tightening financial conditions while risking a sharp economic slowdown. And God forbid that scenario of stagflation, plaguing some Eurozone countries, hits Japan next. A stagnant economy with high inflation is the worst case for any central bank, and it might push investors abroad, weaken the BOJ's credibility, and trigger a broader rout in global market sentiment. So what's the most likely scenario moving forward? In the immediate future, Ishiba's new administration seems to align with Governor Ueda's caution. The sense is that now is not the time for more rate hikes. Japan's new leadership doesn't want to risk a destabilizing blow to capital markets at a crucial political time. Leading analysts expect the BOJ to hold rates steady through the end of the year, despite repeated whispers of more hikes down the road. But early 2024 could be much trickier. If Japan's core inflation continues peaking at 2.5% to 3%, the BOJ might have no choice but to hike rates more aggressively in early 2024. Ultimately, this situation is one hell of a tightrope act for Japan's central bank. The fragile balance Japan must achieve between keeping the fragile economy stable via low rates and responding to inflationary pressures that could sap consumer purchasing power is formidable. But one thing is clear: Japan cannot move in isolation. Its decisions are being watched by every major economy around the world. As the US, Europe, and other advanced economies contemplate more aggressive cuts, the BOJ's headache intensifies. And as always, the greatest irony in global money management is this. While Japan wanted to finally loosen its grip on zero-rate policy and turn toward growth, global chaos is forcing it to hesitate at this pivotal moment. So whether you're a small business owner in Tokyo, a banker in London, or a trader in New York watching the yen-dollar relationship with bated breath, you can bet the BOJ's next move will resonate far beyond its own borders. Let's see how the global economic chessboard reshapes over the next few months. We'll keep a sharp eye on it together. Until then, keep questioning, keep calculating, and remember, economic forces don't operate in isolation. They affect you more than you might think. Let's now take a moment to zoom out further, beyond the immediate interest rate policy and inflation dynamics in Japan, and dive deeper into how Japan's rate decisions reverberate through the interconnected global economic system. It's important to realize that the BOJ situation is a kind of economic microcosm that mirrors challenges seen in other major economies, though Japan happens to be sitting close to the economic epicenter. First, let's consider the trade networks. Japan, as the world's third-largest economy, is integral to global supply chains. It's not just a market for finished goods, but also a crucial supplier of intermediate goods, particularly in high-tech industries such as semiconductors, robotics, and automobile components. A disruption in its economy could easily send ripples through global trade channels, much like how China's economic deceleration has rattled global growth over the past decade. If Japan tightens interest rates too quickly and businesses falter, the knock-on effects could be immense. Japan's trading partners, most notably China, the US, and the EU, could feel the squeeze as demand for Japanese parts and intermediate goods dwindles. This could further strain already fragile global supply chains still reeling from the COVID-19 pandemic, exacerbating production bottlenecks across industries like automotive, consumer electronics, and heavy machinery. Moreover, Japan relies heavily on imported commodities. Rising interest rates could further strengthen the yen, potentially lowering the relative costs of imports but simultaneously cramping export competitiveness. This could trigger trade imbalances, hurt domestic industrial output, and add further pressure to Japan's struggling manufacturers. In a global economy already on edge, Japan's decision to tighten risk adds to the uncertainty. Now, let's explore the impact of currency fluctuation, which will likely become one of the hottest topics moving forward in the BOJ's decisions. With the yen already following a volatile trajectory, the question of whether Japan can afford to continue rate normalization becomes even more acute when you look at the impact on global capital flows. One particularly dangerous possibility: if the BOJ raises rates too aggressively compared to its peers, the yen may appreciate drastically. This could lead to an unwelcome round of reverse carry trade. Investors could stop borrowing in yen to invest in higher-yielding assets abroad, such as U.S. Treasuries or euro-denominated bonds, and instead repatriate their funds into yen-denominated assets. Such inflows might temporarily strengthen Japanese financial markets, but the subsequent collapse in liquidity abroad could wreak havoc on global emerging markets, which have long piggybacked off cheap Japanese capital flows. In fact, many of these economies, such as Brazil, Turkey, South Africa, and Indonesia, have already been grappling with high inflation, currency pressure, and sluggish growth. If Japan's funds stop flowing outward, these economies could experience dire crises in liquidity. Moreover, dollar-yen fluctuations serve as a key barometer of market risk globally. If the yen experiences too much volatility, it could destabilize international trade and finance with erratic exchange rates, further aggravating uncertainty and triggering risk-off sentiment worldwide. On the inflation front, Japan's problem with the inflation behemoth strikes a wider chord with the current global macroeconomic landscape. Inflation is not Japan's problem alone. It's a major concern for other advanced and emerging economies. But herein lies the irony. If Japan escalates rate hikes to tame inflation, it could inadvertently fuel higher energy and food prices globally. Japan's heavy reliance on energy imports, particularly from the Middle East and Southeast Asia, combined with excessive tightening, could spoil its own delicate consumption recovery and, by extension, push up worldwide energy demand imbalances. Consider how energy markets have behaved over the past few years. Asia's middleweight economies like Vietnam, Thailand, and Malaysia are wrestling with skyrocketing input costs for commodities, food, and energy. While a strong yen might alleviate Japan's burden in sourcing these resources, the fate of other neighboring economies diverges. A Japan that tightens too quickly may inadvertently intensify cost-push inflation abroad, especially in Asia's smaller economies that rely on dollarized global trade. This leads us directly to the next macro implication: the impact on Japan's neighbors, specifically China and East Asia. While the rest of the world, especially the Western powers, are eyeing each other's rate policies, it's Japan's immediate influencers and competitors within Asia we need to focus on. China, notably, is in the midst of its own economic deceleration, grappling with a trifecta of property market crises, weakening domestic demand, and export slowdowns. Now, any aggressive moves by the BOJ could exacerbate these pressures on China, which relies significantly on Japanese industrial goods. Meanwhile, China's ongoing stimulus policies run completely counter to Japan's potential moves toward tightening, which further complicates the mix. A rate hike path in Japan could squeeze trade links with China even more. The weakening Chinese yuan and an inflating yen could prompt severe trade imbalances between these two East Asian giants. Chinese exporters already strained by U.S. tariffs and global decoupling could face even harsher headwinds, potentially escalating already fragile U.S.-China geopolitical tensions. While we have dived deep into the economics, we simply cannot ignore the politics surrounding these decisions. Notice how Prime Minister Ishiba is exercising an unusually heavy hand in guiding BOJ policy. Ishiba's intervention underscores a larger fear. Japan's political apparatus might see the BOJ as more of a subordinate institution rather than an independent entity designed to control monetary policy free from political interference. You'll recall what happened during the Shinzo Abe years, when Abenomics became synonymous with stark monetary experimentation designed to fire up Japan's economy from the long decade of stagnation. The BOJ, under Haruhiko Kuroda, became deeply intertwined with government fiscal policy, with quantitative easing (QE) retaining only a thin veneer of central bank independence. Fast forward to today, and these dynamics are back in the spotlight. Ishiba has made it abundantly clear that he's reluctant to see any further rate hikes soon. This puts Governor Ueda in a potentially precarious position. Should Ueda bow to political pressure to hold off on rate hikes, might he end up damaging the BOJ's credibility in the long run by allowing inflation to fester? And conversely, if Ueda moves independently and pushes for more rate hikes, how will this square with the government's broader economic strategy? Policymakers across the globe, from the White House and Downing Street to the Bundeskanzleramt, are quickly recalibrating their strategies, understanding that BOJ policy doesn't exist in a vacuum. And the reality is this: central bank independence is becoming a rare phenomenon in times of crisis. The boundary between economic guidance and central bank independence is fast eroding in other regions as well. Whether it's the sharp messages sent by the Fed's tussle with DC politics during U.S. debt ceiling negotiations, or the mess of central bank decisions being politicized across Eastern Europe, Japan's move to navigate its rate trajectory might well define future models of hybrid economic governance globally. So where does this leave you? Whether you're an average Joe or Jane interested in the rising cost of living, a professional in finance managing assets, an exporter, or a vested company owner, here are the key takeaways. 1.4 Everyday citizens. Japan's tightening decisions will likely increase daily costs domestically as businesses pass through higher borrowing costs. But if you're living in other countries, especially emerging markets, be wary. Japan's rate hikes could also amplify global inflationary pressures, leaving you with higher prices at the pump, grocery stores, and even when paying for basic utilities. Watch out for currency volatility globally, especially if you deal with major imports or if the yen becomes overvalued against the dollar or euro. 2.4 Financial professionals. Brace for heightened volatility in bond markets, forex, and equities. Portfolio managers should be particularly cautious about rate risk duration and rebalancing emerging market exposures. With U.S. rate cuts seemingly on the horizon and many European nations following suit, the carry trade mechanism might tilt sharply in unpredictable directions if the BOJ continues its policy divergence. A stronger yen could weigh heavily on multinationals dependent on cheap Japanese capital while exacerbating global macroeconomic risks. 3.4 Exporters and businesses. Japan's next rates could severely impact your trade flows. Exporters should prepare for possible disruptions in the value chain, whether you're dealing in tech components or larger industrial goods. The relative strength of currencies will shape market volatility, affecting everything from contract pricing to trade margins, especially if you're focused on Asia-Pacific trade routes. For 4 Policymakers and economists, central bank independence isn't just a talking point anymore. It's becoming a critical feature or flaw, depending on your stance of economic resilience. Keeping a close eye on how geopolitical figures like Prime Minister Ishiba navigate these waters will determine the future of economic policymaking globally. As pressure mounts for governments to intervene amidst stagnating economies, will they pull in their central banks as subordinate players in broader political strategy? As much as we've broken down the BOJ's decision-making process and its potential global impacts, the truth remains: we are still at the mercy of unfolding events. What makes this situation fascinating, and, for many, deeply unnerving, is the sheer unpredictability of how these global forces will align. Japan is now poised at a crossroads, navigating between its domestic imperatives, taming inflation, sustaining growth, and ensuring financial stability, and the signals radiating from other major economies that are aggressively easing monetary policies. Yen, the Bank of Japan's upcoming moves could determine not only the trajectory of its own economy but also influence how financial markets across the world operate in the coming months and years. For now, all eyes will remain glued to the BOJ's next move, and any changes will undoubtedly send more shockwaves through global markets already struggling to recover from pandemic-induced disruptions. How this plays out will be crucial for every stakeholder, whether you're handling personal finances, operating a global business, or managing institutional portfolios. At this point, we cannot ignore the larger strategic question. How central banks' actions either synchronize or diverge has always been a key factor in how the global economy weathers periods of instability. Right now, the concept of economic divergence stands out more than ever. Let's not kid ourselves. Central banks globally are engaged in a delicate and increasingly public game of monetary strategy poker, and each central bank has its own cards to deal with. One wrong bet, particularly in an interconnected global system, can lead to contagion among markets that quickly undermines even the best-intentioned policy interventions. In normal times, central banks often move in a relatively synchronized fashion, especially among advanced economies. When the U.S. started raising rates between 2016 and 2018, there was a clear domino effect, with other major central banks eventually following suit to maintain exchange rate stability and prevent massive capital outflows. In a way, policy coordination became an unspoken rule of international monetary governance, where disjointed efforts were tacitly avoided to minimize destabilizing effects. However, we are no longer in normal times. The global economy is marked by an unprecedented degree of fragmentation, not just in terms of geopolitical alliances but in terms of monetary goals. The Federal Reserve might choose to dance to one tune, hoping for a soft landing in its economy, while Europe and Japan hum along to an entirely different rhythm, driven by local inflationary and growth conditions that conspire against them. What comes next for Japan and the world? The critical scenarios. Let's explore a few likely scenarios based on the current macroeconomic environment. Scenario 1. Japan bends to external pressure and delivers a timid hike. In this scenario, the Bank of Japan, under increasing pressure from both domestic and international forces, might choose to carry out a modest interest rate hike, perhaps raising the benchmark by an additional 0.1% or so by early 2024. This cautious approach would aim to telegraph Japan's gradual exit from zero interest rates, without creating panic within global markets. Investors, eyeing Japan's incredibly low rates as a liquidity source, wouldn't rush to pull their capital from its assets, at least not right away. The yen might appreciate moderately, but not enough to send Japanese equities into a tailspin. Foreign firms, especially multinationals reliant on cheap yen-denominated funding, will scramble to adjust, but a slow BOJ normalization could still allow for a phased pivot toward other capital sources or hedging mechanisms. However, this move would likely keep inflation in check for a while domestically, but at the expense of potentially delaying the long-term structural adjustments needed to ensure Japan doesn't fall into yet another long-term deflationary cycle. Scenario 2. BOJ delays further, waiting for global conditions to improve. Alternatively, we could see the BOJ decide to postpone further rate hikes altogether, choosing to maintain its ultra-easy monetary policy in alignment with the global easing trend. Under this scenario, the BOJ will likely bet on global demand stabilizing before attempting any major monetary tightening moves in early 2024 or beyond. While this may ease immediate pressure on markets and maintain favorable borrowing conditions for businesses, the real risk here is that inflation could spiral further out of control. This could leave the BOJ backpedaling to implement restrictive measures later, right at a time when Japan, or worse, the entire world, is transitioning into a more uncertain growth phase or potential recession. It's not just domestic inflation that would pose a risk. Such a decision could also reignite a surge in the yen if the currency markets decide that other economies' rate-cutting trajectories are diverging too aggressively from Japan's ultra-low rates. Scenario 3. Global economic crisis forces Japan into a radical pivot. In an extreme scenario, Japan may have no choice but to sharply reverse course if a major global crisis, perhaps another banking crisis or geopolitical shock, threatens the country's economic stability and the broader financial system. Depending on whether, say, Europe's banking system takes a hit or there's a dramatic escalation in political instability within a major economy like China or the US, Japan may find itself rapidly returning to its crisis-era playbook, once again slashing rates and deploying heavy doses of fiscal stimulus. At this point, it would essentially undo years of effort to wean itself off permanent zero-interest rate policies. Suddenly, the entire world would be reminded that Japan, despite its desire for normalization, remains deeply vulnerable to external shocks. This would not just be a challenge for Japan. It would ripple through global markets, sending shocks to currency markets and reigniting the carry trade in extreme volumes. In this scenario, Japan's rate policies would once again become unintentionally destabilizing to other emerging markets that have been relying on Japan's steady hand to support growth. So, where does this leave us? As much as the Bank of Japan and Japan as a whole wants to execute its carefully balanced dance with rate hikes and a retreat from its extreme policies of the past, much larger forces dictate these moves in the end. The uncertainty is greater than ever. Major question marks hang over the global economy because, in truth, the old systems and responses don't seem to work with as much predictability anymore. The inflation control dialectic of aggressive rate hikes versus the easing paths of major central banks is a microcosm of this tension. Meanwhile, Japan, a traditionally cautious player in the global monetary field, is caught in a bind. It wants to restore normality late in its post-1990s curve, but is finding that doing so demands playing against an entire cast of international characters who aren't following the same script now. For everyday citizens and professionals alike, the complexity of the situation demands more attention than ever before. Central bank policy is no longer a small matter reserved for esoteric financial conferences. It impacts your wallet, your job, your savings, the value of your assets, and even the broader trade system we all depend on. In the coming months, watch closely as new economic data unfolds. Key reports like U.S. jobs numbers, Eurozone inflation reports, and China's growth statistics will determine whether Japan enjoys a window for carefully selecting its next moves or gets caught off guard by a growing storm. In short, stay vigilant, keep informed, and remember, every percentage point shift, every hint in policy guidance, every yen that strengthens or weakens stands to either stabilize or destabilize global economic dynamics at a time when stability feels in short supply. Thank you for tuning in to today's deep dive into the conundrum facing Japan and the global economy. As always, I'm here to interpret the economic chessboard, call out what you won't hear in the mainstream narrative, and help you piece together the larger puzzle. Until next time, stay sharp, stay smart, and let's keep questioning the headlines that matter.